Good to see you, Kelly.
So I'm interested to hear that you're on the more, can I call it dovish side here? What do you foresee?
Well, we're on the dovish side because we're expecting a recession. You know, where I have some difficulty with kind of where the consensus is right now is the idea of rate cuts and a soft landing. When we have an inflation rate that's above 3, that doesn't square the circle. You know, if you were to kind of, you know, I don't know, land on planet Earth and look at the United States economy and see a 3% inflation rate and an unemployment rate of 3.7, you wouldn't be asking yourself when we were going to cut rates. You'd be asking yourself when we're going to start increasing rates.
I think that there's a good possibility that we won't have a recession in 2024.
Yeah, I think that alludes to my next question. Why do you think the U.S. has avoided a recession so far, and are we nailing that soft landing?
I think it's been because of the employment situation, and a key reason for that is because businesses spend so much time and energy hiring people during the labor shortage period that they're very reluctant to lay them off now. You haven't had that weakness in labor markets that I think you normally would have had and would have given a recession starting last year. That doesn't mean we won't have one, but it means whatever it is, it's delayed.
Feeling the jitters about the U.S. economy? You're not alone. Experts are buzzing on different opinions concerning the U.S. economy. Some of them believe recession is inevitable. Others think the worst has already happened. Therefore, we're in a recovery mode. One of them is Gary Shilling. Gary believes a recession is yet to hit the U.S. economy. In his words, he claims the recession has just delayed but will definitely happen. In this video, I unveil the current condition of the U.S. economy and why what Gary Shilling is saying makes sense. Let's hear from Gary.
The economy has been stronger than most people expect, stronger than the Fed wanted it to be, let's face it. And I think it's got an unsustainability there. We've had more strength in employment than probably is commensurate with the state of business. So I think that strength in the labor markets, it's the good news, bad news kind of situation.
As we all know, the United States boasts of being the world's largest economy, a powerhouse fueled by innovation, a vast consumer base, and the mighty dollar. In the past decade, the United States has boasted real GDP growth of 2.1%, well above the average of 1.7%. The U.S. economy has other key strengths characterized by high productivity levels, technological innovations, and competitiveness. The U.S. is a land for groundbreaking ideas and efficient production. From Silicon Valley's tech giants to the fertile fields of America's heartland, the U.S. churns out inventions and goods that keep the world moving. This translates to a highly competitive economy, constantly pushing boundaries and attracting investment. Another strength is the U.S. flexible labor market. In recent years, the U.S. has shifted towards a service-based economy that benefits from a vast domestic consumer base. This shows that businesses can adapt their workforce relatively easily, allowing them to respond quickly to changing market demands. Plus, the U.S. enjoys a relatively young population compared to other developed nations, offering a steady stream of skilled workers for years to come. The U.S. dollar reigns supreme as the world's reserve currency. This means other countries hold a significant portion of their foreign reserves in dollars, making it highly desirable and stable. This gives the U.S. significant economic leverage on the global stage. What generated the fear of recession in the U.S.? The U.S. economy is undeniably a global powerhouse. Yet, even the strongest economies experience hiccups, and many are worried about the recent whispers of a potential recession. Inflation, the rising cost of goods and services, has been a major concern for American consumers. While the Federal Reserve is taking steps to bring it under control, the recent inflation surge has eroded purchasing power and dampened consumer confidence. This, in turn, has led to decreased spending, which is a key driver of economic growth. Now, to combat inflation, the Federal Reserve has raised interest rates. According to CNBC, the federal funds target rate has remained at 5.25% to 5.5% since summer 2023, the highest in over 20 years. The Fed raised the rate 11 times between March 2022 and July 2023 to combat ongoing inflation. While this is a necessary tool, it can have a ripple effect. Higher interest rates make borrowing more expensive, slowing investment and economic activity. Additionally, stock markets tend to dislike rising interest rates, which can lead to market volatility and a decrease in consumer wealth. This can further dampen spending and contribute to a recession. Another major contributor to the fears of a recession in the U.S. economy is the slowdown in other major economies like China or Europe, which can have a domino effect, impacting global trade and ultimately affecting the U.S. Income inequality is also a major contributor to the fears of a recession in the U.S. economy. The gap between the rich and the poor is wider in the U.S. than in most developed nations. This can lead to social unrest and hinder overall economic growth, as a large portion of the population has less disposable income to spend. Another major concern is the ballooning national debt. Years of government spending exceeding revenue have created a significant burden. As of February 1, 2024, the U.S. national debt was $34.16 trillion, about 99% of GDP. The debt is expected to continue to increase over the next 30 years. This limits the government's ability to invest in infrastructure and social programs, potentially hindering long-term economic growth. The U.S. has traditionally been a champion of free trade, but recent years have seen a shift towards protectionism. Trade disputes with countries like China raise concerns about the future of global economic cooperation. Additionally, the U.S. faces stiff competition from other emerging economies in Asia. While the U.S. economy is undoubtedly a force to be reckoned with, navigating the challenges ahead requires a delicate balancing act. Addressing income inequality, managing the national debt, and adapting to a changing global landscape will be crucial in determining the U.S. economic future. The U.S. would need to harness its strengths in innovation, productivity, and a skilled workforce to ensure its economic engine continues to hum for years. Finally, the lingering memory of past economic downturns can make people more sensitive to signs of trouble. Even if the current situation isn't as severe as previous recessions, the fear of a repeat can lead to cautious consumer behavior and decreased business investment, potentially pushing the economy toward a recession. Why the fear of recession is slowly fading away.
Goods inflation had a big jump during the pandemic. That's faded. We were running over 9% year-over-year inflations, and they're now down, 3 or 4%, depending what measure you pick.
While fears of a recession were prominent not too long ago, there are signs that these anxieties might be easing slightly. The Federal Reserve's interest rate hikes aimed at taming inflation were initially seen as a potential catalyst for a recession. However, the Fed's measured approach might be finding a sweet spot. By raising rates gradually, they might be able to control inflation without slamming the brakes on economic growth too hard. While inflation remains a concern, there are some indications that it might be peaking. Recent data might show a slowdown in price increases, offering a sigh of relief to consumers and businesses. The U.S. job market continues to show surprising strength. Unemployment rates remain low, and job growth continues in some sectors. This indicates that the economy might have more resilience than initially thought, potentially buffering against a recession. Despite inflation concerns, American consumers still have significant savings accumulated during the pandemic. This pent-up demand could continue to fuel consumer spending, a vital engine of economic growth. While there are always concerns about global economic slowdowns, some major economies show signs of stability. This could bode well for global trade and potentially benefit the U.S. economy. Now, according to Gary Shilling, let's have the different reasons why the recession is still inevitable. 4 reasons why the recession is still inevitable, based on Gary's interview. In a recent interview with Gary Shilling, he revealed some reasons why he thinks the recession will still be an issue to tackle soon, even though it is not here yet. To help simplify all this for you, I have highlighted these reasons, which I will be going through one at a time. Strong employment numbers mask weakness.
And I think it's got an unsustainability there. We've had more strength in employment than probably is commensurate with the state of business. So I think that strength in the labor markets, it's the good news, bad news kind of situation.
Now, it's nothing new that the job market is booming. It's all over the news, and companies are hiring like crazy, with unemployment rates at record lows. All he is trying to say is that it's all a facade. Companies constantly announce new hires, and the unemployment rate is down significantly. It sits at around 3.6% as of March 2024, which is historically low. Economically speaking, this low unemployment rate is often seen as a sign of a healthy economy, with businesses needing more workers to keep up with consumer demand. This is great news, but Gary thinks otherwise. Shilling argues that the strong employment numbers are unsustainable and don't reflect the true state of business. He believes businesses are reluctant to lay off employees due to past hiring struggles, but this might not hold for long. Now, while overall job growth numbers look impressive, the gap between the number of job openings advertised by companies and the number of people hired is narrowing. This could indicate that companies struggle to fill open positions, even with a large pool of applicants. To that end, Shilling suggests that this holding on to employees by businesses might not be sustainable in the long run. If economic conditions change, businesses might eventually be forced to make adjustments, potentially leading to layoffs in the future. This, in turn, could weaken consumer spending and contribute to a recession. High level of prices, not just inflation rate.
But that doesn't mean prices are coming down. And people are looking at it and say, wait a minute, I'm paying 50% more for this or that. So it isn't just the rate of inflation, it's the level of prices that are very disturbing to a lot of people.
Inflation is a technical term that measures the overall price rise across a basket of goods and services. While the inflation rate might show signs of slowing down, Shilling thinks that this doesn't tell the whole story for consumers. Shilling argues that even though the inflation rate might be coming down, the actual price of goods remains high. This puts a strain on consumers who are feeling the pinch. Why? Because even if the overall inflation rate is reported at 3.9% and the price of an item in a local store increases by 20%, it can significantly impact your budget. This is called the sticker shock effect and can be particularly harsh for essential items like groceries and utilities, leading to financial strain even if the inflation rate seems moderate. Also, if your salary increases at the same rate as inflation, you might not be able to buy the same amount of goods as before. This is because the value of your dollar has decreased due to inflation. This can lead to frustration and a pullback in spending, potentially slowing down economic growth. High prices, even if explained by inflation data, can have a significant psychological impact on consumer behavior. People might become more cautious with spending, delaying purchases, or cutting back on discretionary items. This can lead to decreased demand for goods and services, potentially triggering a recession. Traditional recession indicators pointing downward.
If you look at the normal harbingers of recessions, the yield curve, the leading indicators, you look at small businesses. Small businesses are very sensitive to economic conditions because they don't tend to be very heavily capitalized. So they got to react in a hurry when business starts to ease off for them, and they are cutting back on their employment and other areas. So there's a lot of very traditional and extremely reliable forerunners of recessions.
Economists rely on a toolbox of indicators to assess the economy's health and predict potential recessions. Shilling highlights traditional recession indicators as signs that a recession might be coming. The fact that the Fed started raising rates 2 years ago typically precedes a recession within 2 years on average. One of these tools is the inverted yield curve. This occurs when short-term interest rates are higher than long-term rates. Historically, this has been a reliable indicator of an impending recession. The logic behind this is that investors typically seek higher returns for longer-term investments due to the inherent risk. An inverted yield curve suggests a lack of confidence in the future, potentially leading businesses to pull back on investments and consumers to tighten their spending. The inversion of the yield curve from 2022 to 2023 reached a depth comparable to the notorious 1929 scenario. Another tool is the leading indicators, which are economic data points that tend to precede changes in the overall economy. A decline in leading indicators can signal a potential slowdown or recession. Leading indicators include manufacturing production, new business orders, and consumer confidence surveys. Lastly, there are struggling small businesses. They are often considered the backbone of the U.S. economy. When they struggle, it can be a sign of broader economic woes. If small businesses are reporting difficulty obtaining loans, experiencing declining sales, or facing layoffs, it can be an indicator of a potential recession. Discretionary spending becoming cautious.
So it's really telling you that there has been that sort of, but these are discretionary spending items. There's a lot of signs that people are being more cautious in their spending.
Fear of a recession often leads to a change in consumer behavior. Gary Shilling suggests that people might be becoming more cautious with their discretionary spending, a potential sign of a slowdown in the economy. Discretionary spending refers to the money people spend on non-essential goods and services. This could include anything from dining out and entertainment to vacations and new clothes. These purchases are often the first to be cut back on when consumers feel uncertain about the future or face financial strain. This concludes the exploration of the U.S. economy and the potential for a recession, all through the lens of Gary Shilling's insight. Remember, the future is uncertain and economic forecasts can change rapidly. Do you completely agree with Gary, or do you have other concerns about the recession that you want to highlight? Comment it down below. Like, share, and subscribe to my channel for more epic content like this. See you on the next one.